Let's kick off this morning with our regular Sunday morning commentator, Christoph Ruhl, sitting in Germany. He is senior research scholar at the Center on Global Energy Policy for Columbia University. Christoph, we saw crude Brent, that is, break through $85 on Friday before retreating a little bit below 85 on the close. And we also saw Bitcoin once again surging back into the headlines, moving well above $62,000, indicating, at least from previous guidance, that it's got a risk-on atmosphere, risk-on appetite in the markets. Your thought on reflection?
I thought that's true. That's exactly true. The comparison of crude oil and Bitcoin hasn't occurred to me, but it might become apt in the future. We have seen markets generally sort of going into high gear, risk-on mood everywhere. We've seen the same things which drive oil on the demand and supply side, less than natural gas or coal prices, substantially less if we compare, but still, if you only look at oil, nothing in sight which would immediately sort of put a brake to it. Although it starts to become I think people start to become a bit more nervous and the fluctuations on the way up become a bit more bouncy. And so I was long oil, I sold part of that. It feels like it's gone a long way. The other two things, when we look back last week, which were interesting, where there was two major flagship reports being published. One by the IMF, the World Economic Outlook, the other by the International Energy Agency, the World Energy Outlook. And a bit ahead of time, so we'll be in time for the COP meetings. And I think to condense them is also interesting. So the IMF was basically saying, in growth, I don't go into the details, but just to summarize, growth a little lower, inflation a little higher. And during the presentation, then the chief economist went out of her way to say, yeah, but no stagflation yet. And then the second big point they made is, when we always talk about people refusing to get vaccinated, they said, okay, in the rich countries, by their definition, about 60% of the population at large is vaccinated. In the poor countries, 95% of the population are not vaccinated. And this is going to drive a wedge into global economic development, which is really going to be heavier than normal. And at the same time, we had the IEA coming out with a report which really was much more focused on climate change than anything else. Also interesting because they continue to use this kind of scenario technique, where they have different scenarios, what if, and then try to cover the horizon. But they changed the scenarios. They added one, which is sort of a pledge scenario. So what if all the pledges which countries have made to decarbonize them are actually fulfilled? And the answer is that even that doesn't get us close to the Paris targets. And they dropped one scenario, which was the policy, I forgot how they call it, the scenario where they just policy as usual would continue. The worst case, basically, from a climate perspective. They dropped it. They don't even follow that anymore. And their conclusion is, okay, we need to spend more money and then this energy transition will eventually happen. We need to double our efforts and it will create green jobs and it's doable and all of that. I can't help it. When I read their reports, the thing which it screams at me is that this energy transition along these pathways will never happen. And so these are the two sort of intellectual backgrounds from last week, which otherwise didn't have too many facts to display.
Let's welcome Maliha Bengali, founder of MB Commodity Corner. Maliha, it seems in all of this optimism, the markets, there's nothing really to pull them back, but is there? Biden's struggling to get his signature policies through Congress. China is warning against further blackouts in terms of power outages. Do these sort of events finally put a cap on this sort of euphoric outlook?
So we feel there's a bit of a dislocation in asset classes. The macro markets, forgetting equities for a second, are talking about stagflation. There's no doubt that given the surge in gas prices, coal prices, even copper's breaking out, and I'll get back to it, but oil prices rallying with the gas prices, stagflation is definitely a concern because you look at the PMI indicators, you look at the growth numbers, they're actually pointing downwards for both US and Europe. So the equity market is thinking, right, we have lower GDP growth going forward. China is facing blackouts, European factories are shutting down. That will all lead to lower PMI numbers. But yet the equity market, which is actually not doing much, is the commodities that are rallying because of the inflation fears. The US bond yields are threatening 1.6% on the 10-year again. So the market is chasing all the inflation sensitive names, and you can see the commodities rallying, but the equity is actually holding back right now. So there's a bit of a dislocation because if we are right and stagflation is a real fear because we've seen the CPI the way it is, I think generally growth, which means equities and risk assets should go lower, not higher, because something is going to snap very fast. And the market can't take this sort of high inflationary shock. And the Fed, we know, is in a bit of a catch-22. They can't print more to get more higher growth because that'd be more inflation. And if they raise rates, that's game over. So they are hoping that this is transitory, but this inflation is not looking like it's transitory because there's some real supply chain bottlenecks, there's some real demand that's taking these commodity prices higher.
Christoph, on that point, I mean, we are sort of baking in the cake now that at least tapering is going to start before the end of the fourth quarter. The market seems to be taking that and spitting it out without any issue.
Yeah, and I pretty much completely disagree with this view just expressed, that you have the equity markets now being the risky investment. It's the only investment in town. I just the opposite. The way I look at the markets, I'm just baffled how elegant and how efficient actually you see different parts of the market move ahead and others falling back for a while now. So we have seen the tech stocks not taking a beating, but slowing down considerably, energy catching up, which was way behind if you compare to the pre-COVID metrics. And then we have seen the switch from growth to value stocks and now probably seeing switching back a little bit. What has happened in equity markets, this kind of not moving in unison very much anymore, but really having a distinction for different segments of it, indicates to me that this rally has some legs to go. That's the first point. Second point is what you said, the tapering back and forth. I think everybody in his right mind knows that there's an inflationary threat by now and the tapering has to happen. And not tapering, the asset purchases of the Fed, of the Japanese bank probably least, but certainly also of the ECB and of the UK central bank have to stop, have to scale down at least and eventually peter out. I don't think anyone seriously, people would argue, say, okay, it would be nice if it continues, but this is recognizing that this is now the last free drink at a party. And then finally, when it comes to interest rate increases, I think if inflationary numbers as we have seen them right now, so between 3 and 5%, and the big economies are hovering around, and it looks like that, even an increase in interest rates will be something which probably can be engineered without a major breakdown. And don't forget, we all agree that this market is really, really highly valued. So if it tanks for 10, 20% short term, I think there's still so much in the money in the system that we will buy an opportunity, even with an interest rate hike in the US.
Maliha, we're finally seeing refiners come in the money now. Pretty much everywhere margins are looking healthy, and most notably perhaps Asian refining margins for jet fuel climbed in October to their highest level since January 2020, with air travel demand coming back in Asia. Refiners are looking good.
You're absolutely right. So we looked at the last inventory data that came out on the 4-week average basis. Demand actually been holding up really well on the distillate side. Gasoline's a bit softer, but if we foresee a pickup in travel demand, you're right. You're absolutely right. They can take this off global demand higher. But my concern really is more macro than micro. We know the oil market's tight right now, and OPEC Plus is doing a very good job in releasing oil in dribs and drabs. They've said they're not going to increase further, even though Russia said they have more capacity to increase more. We think they're being very disciplined. It is the next 3 or 4 weeks where you have a bit of a weak demand shoulder period before the actual Q4 Northern Hemisphere starts. If we get a cold snap, you're absolutely right. Oil can go to 100, 120 if we get a lot of things aligned in the correct way. But supply is picking up. We're a bit worried about the macro side in terms of demand shocks and how that plays itself out. But right now, Christoph made a very good point. The market's all about liquidity. The Fed may talk about tapering, but they're still buying $120 billion of treasuries every single month, even last week. So end of the day, there's a lot of liquidity in the market. And that is what's sticking, the growth value rotation, but also is holding asset prices higher.
Another dynamic we saw, Christoph, last week and sort of the weeks coming into last week has been this idea of with the price of natural gas and coal being at such high levels that it's drawing in fuel oil products to play the role in power generation. How do you see that crossover continuing as we go forward, where it would appear, according to most analysts, that oil demand will be greater than supply by about 1 million barrels per day in the fourth quarter?
That's a very, very good and a very important question, and there is no unique answer. You probably know, like me, that when you look at the investment banks and other analysts, so the estimates go from 200,000 to 1 million of fuel oil being consumed in the power sector. I looked into this a little bit. I don't have a unique answer. I don't anybody can know because we don't even have an account of dual-fired power plants where you can switch from gas to fuel oil directly, most of which are small and are in Asia. We don't know how many generators can be taken into account when they switch off gas or coal production of electricity in places like China. So, but we do know or should know that these prices quoted for coal and especially for gas are not average prices. These are the peak spot prices, underneath of which there's a huge amount of gas being transacted still at long-term contract prices and at lower spot prices and gas which has been redirected when contracts have been broken. So these numbers which you see are headline numbers which apply for a small segment of gas, and that means that the competition between natural gas and fuel oil prices will kick in pretty soon because oil is also relatively expensive. So lo and behold, I think it's an important component, but I don't know exactly how important it will be.
Another factor, Maliha, we saw last week, which normally would be a very bearish signal for oil markets, was China once again cutting oil import quotas for independent refiners, which would, which would guide towards lower imports of oil into China. Yet the market didn't even react to that.
You're absolutely right. We are not impressed with the Asian demand numbers. The crude import numbers have been stagnating for months now. We think the rally in oil is basically a very macro driven. There are a lot of generalists out there playing the inflation theme, the macro theme, putting money into commodities, and that's obviously taking WTI and Brent oil spot futures higher. There is tightness, but I think the macro flows are exacerbating the actual physical tightness that's in the market. We feel because on the demand side, nothing is screwing out that market is really that tight yet into winter.
But on that one, then we may have a long-term. This I agree, it's a flash. But incidentally, I just come back from Cyprus a few hours ago, and I was amazed. I mean, flights full, lots of tourists there. People saying it's almost back. So there clearly is now this phase where people spend money, and a lot of that money which they have saved is being spent on travel and other travel inside and outside countries, oil-intensive products. But overall demand doesn't look to me very strong. And I think these efficiency improvements we talked about will continue. And what we see, I mean, even the IMF now has a growth forecast for China for next year, which is 5.4%. That is really not very high by historical standards. And that means that the last demand growth centers are being eroded. And this little thing which we threw out from this one paper which I advertised here, that basically oil demand is likely to peak within this decade, still seems to be in the cards to me. So it's like with economic growth, there's this one thing which is the flash in the pan in reaction to COVID, and then there's the other thing of long-term high sustainable growth. And the other thing, the long-term high sustainable growth, looks further away, not closer.
Maliha, we also saw last week, again, as we ramp up to COP26, all of the ramifications around that started to come to the forward, whether there will or won't be a carbon price. We had sort of news overnight that the president of China, Xi Jinping, will not be going to the summit. Your thoughts, does COP26 start to become a factor for the markets?
It does and it should, but it's interesting how governments are, looking at policies right now. We've seen China restart 26 coal generators. We've seen UK restart plants. Right now, it's all about economics. So the governments can talk about climate change and sustainability as much as they want. What they're doing is very, very different. I'm a little skeptical because end of the day, they're looking to, like, China's main focus is to make sure they don't have social unrest. There's heating, there's no shortages, the people are not, uncomfortable. And for that, they will do whatever they can, whether it's pollution or whatever it is. I don't think that's going to be their object versus actually starting to get the gas shortage contained. So I think that's an agenda that's very much for the future. What they do in the near term is entirely different, but it's very hard to tell right now because governments are seriously stressed everywhere right now.
On that point, Christoph, the new German government being formed at the moment, indicating that they may phase out coal. What are the other elements of this new government and its ramifications for the markets, do you think, in the immediate term over its first 6 months?
It's a curious construct, this government, because it has the Social Democrats who clearly stand for more government, more regulation, gradual phase out from coal and also from nuclear. So support of the energy transition, if not hardcore. And then on both sides of it, it has these smaller partners. Once the Greens, which is clear what they stand for in terms of energy, and the others, the Liberals, which are sort of the most market-oriented smaller group in Germany. And many people are just waiting, making bets how many months it takes until between the Liberals and the Greens there will be some breakup. That we cannot foresee, but I think lo and behold, this is going to be a government which is standing for more government, more subsidies, more regulation, more support for climate change. And when we step back, this is what we see. I mean, the situation is incredible, right? There's 8 billion people on this planet, the vast majority of which would love to have at least a washing machine or a regular heating or cooking facilities, and will need more energy, full stop. And on the other hand, we have the rich countries where the moment prices go a little bit higher, everybody's afraid of riots. And look at Spain now, so everywhere, in France, everywhere, the higher prices are subsidized away. This is a short-term fix, and if the energy transition is serious, prices will have to rise by carbon prices and all that. It cannot be subsidized. It's just too giant a task. And here we are, as long as we're not willing to talk about the elephant in the room, the number of the global population, the energy consumption, and the low prices we have in the industrialized countries, this project will not go anywhere, I'm afraid. And I'm not saying this because I'm not worried about climate change. I'm saying this because I'm an economist and I can add on and on. And these pathways suggested by the IEA and others, these political phrases of this will be good and cheap and create a lot of green jobs and all, you have to call it hogwash because that's what it is.
Malia, in the US, we saw last week the total rig count climbing up by another dozen or so rigs. We're now at 543 on the rig count, which is double what it was a year ago, but still under the 790 active rigs that was in play in March 2020. How do you see that recovery of US oil production starting to play into this market? Because it's now seems to be only got back to about 11.4 million barrels a day.
You're right. We're keeping a very close eye on that because US shale producers have been very reluctant to increase spending in drilling, and they're using all their inventory to do what they can, given their promise to shareholders. So the rig count has picked up, and US oil production last week, as you said, went from 11.3 to 11.4 million barrels per day. That's about a 400,000 barrels per day jump in the last few months. If this number, we don't think it goes back up to 13 because there's been some permanent loss of US production. But we do feel that conversations are happening where people are considering whether they hedge forward production, lock in these amazing prices, and actually give cash back to shareholders and produce. So there's a lot of debate right now. Also, this debate within the White House about should they actually incentivize US producers rather than pressure OPEC Plus to release more production. So we're keeping a close eye on that, but we think that the US market right now should be very incentivized to gradually return back cash to shareholders as well as drill more because the prices are very rewarding right now.
There is a comment by Rustin Edwards in the chat room saying that there is 300,000 barrels a day offline from in the US Gulf Coast due to the Mars platform. On that point, Christoph, vis-a-vis new supply, it is maybe somewhat historic on that OPEC have been so disciplined. There's been no cheating, quote unquote, in terms of taking advantage of these high oil prices. What does that tell you? It seems to signal to me nobody has the barrels to cheat with.
No, not quite. I mean, first of all, we had cheating, if you want to call it that. We had systematic overproduction by one of the big two, by the plus one of OPEC, right? And secondly, we have a lot of other normal-sized smaller members which cannot even produce the quotas they have been allocated to. But we do have spare capacity. What makes the management of it so easy for OPEC at the moment is that it's highly concentrated, as we all know, in the GCC countries. And I don't detect really from the Ministry of Energy in Saudi Arabia a great desire or great offer to say, okay, we're going to release it now. And I can understand that. I mean, oil is not as important as it was anymore. $80 oil, $85 oil, even $90 oil, if there's no economic crisis, is something the markets have been stomaching before. That's what the Saudis must tell themselves, and they're probably right on that account. What is a bit more curious is this kind of cyclicality, this hawk cycle, which we see everywhere developing, clearly in natural gas and coal as it starts to gas globally integrates, but also with this delayed shale reaction. So I made a very important point about the hedging, which is going to start now. No? So what we will see is that eventually, of course, the carrot of very high prices will work. And I would stand by this forecast that by next spring, we see a response in the rig count going back to normal in shale. But a lot of the producers also now have the opportunity to hedge for at least a year out at these prices. Those are the seeds to watch, because that's the seeds for the next downswing, which might be just as volatile as this upswing if it really happens on a grand scale. That's something one should investigate and keep a close eye on.
Well, let's get the survey question in before we talk a little bit about the week ahead with Christoph and Maliha. Brent crude surged as high as over $85 on Friday. It pulled back to a little bit below 85 at the close. But the question is, will Brent break $90 a barrel in Q4 when demand is expected to exceed supply by 1 million barrels a day through Q4 on the average? Supply lower than demand by 1 million barrels a day in Q4. So will we break 90? That's the question for the room, and I welcome your view on that, looking to the week ahead. Maliha, what are the things that seems to be still cooking and perhaps having, I think, longer ramifications for the political outlook of Joe Biden? But in the immediate term, this infrastructure bill, this spending bill that's struggling its way through the Congress and the Democratic Party is being diluted. Your thoughts on its outlook and ramifications for the markets?
So the US government has done a very good job in sort of delaying that debt ceiling debate till December. So they've kicked the can further down the road, but there's still an issue to deal with in December. We obviously have the November midterm elections, and that infrastructure bill is very, very possible, but it's looking a lot less likely. It all depends on what the equity market and the macro markets look like, but we feel that that could be an upside call option, but it's looking a lot less of a possibility right now, especially with all the debt comments. We're keeping a very close eye on the central bank commentary on the taper side. We know the Fed has two key objectives, employment and inflation. We know inflation is a concern for them right now. So the payroll growth had disappointed in August, it disappointed in September. The Fed's a bit worried because their objective has always been to see the growth return back to pre-COVID levels on the employment side to then talk about tapering. So I think the market's looking at a few sort of macro indicators to decide what it does with the dollar, US bond yields, and all those sort of instruments to dictate what happens to asset allocation and stock sector selection. And that will be key for the next month.
Christoph, looking forward, do we still need to keep our eyes on where LNG gas prices go and where the outlook for that is with the winter still ahead of us?
Yeah, we should. I mean, we should look at the volumes and the quantities. And in particular, what is of interest in that department is when Nord Stream 2 starts to deliver, when the German judges, which are so independent from politics, will allow themselves to make the final round of improvements, which will come. It's just a little game how long it takes. But that's an important indicator. And then what happens if there's any volume change through the Yamal pipeline or not? Probably not. Otherwise, if last week was the week of the analysts, then next week is data heavy. So we have Chinese GDP numbers for quarter 3 coming out tonight. And then I think Wednesday, we have a lot of inflation numbers, both from the UK and from the European Union. And we talked about monetary figures, and we talked about this before, that the UK is a bit ahead and might be the first central bank actually to be forced to announce an interest rate hike. But the economy is also not doing very well. So that's going to be what happens. There's going to be an important indicator of how others may.
I mean, it does feel like the UK is the most vulnerable to the stagflation label.
Yes, it does, especially because now it always used, as long as they were in the EU, economically speaking, their advantage was to have an independent currency, so they could sort of benefit from this huge market and then have their currency float between the dollar and the euro and had a benefit from that. Now they have to finance their own expenditures with their own currency, and so their inflationary pressure is higher. And at the same time, with Brexit and all that, the economy is down and needs low interest rates and needs support. And the first thing the new incoming chief economist of the Bank of England was saying was, we have an inflationary problem, which was widely taken to mean that he has a vote on the monetary committee, that he probably may support the balance, which seems to swing towards interest rate increases. But stagflation is other, yeah, okay.
to sort of say, Billy, Italy, you're sitting in Italy. This is the first week coming when the compulsory vaccination is coming into place, where you can't go to work, you can't basically do anything. The first country in the world that has mandated vaccinations across the board. What does that outlook look like just from a local point of view? And do you think that policy will be rolled out in other places?
I think Italy's done a very good job in the mask mandate, the vaccine mandate. That even you walk around into places and offices, people actually take it very seriously. Everybody's wearing a mask. It's not like the UK where I was last week and I was shocked because nobody's wearing a mask and actually nobody cares. So I think there's a bit of riot and protest right now, but generally they will actually manage to roll it off, because Italy suffered very badly the first time around, and people are very cognizant of what happened, and they're actually doing a very good job in respecting the law right now. So we feel that that's going to be doing really well. Whether it happens in the rest of France and other places is a bit hard to tell.
Does it need to happen, or from the point of view of the European and US economies moving into a kind of a post-COVID vaccinated reality, are we now there, so to speak?
In terms of sitting here in Italy, for sure, I see that we have already reached those targets. Draghi did an fantastic job in getting the numbers above 80 to 85%. There's even talk of round 3 boosters, some for the elderly. So yes.
Let's get the survey result and give Christoph the last word this morning. The outlook for oil prices. Whoa, we have a very bullish room here, Christoph. Maybe you shouldn't have sold on that long position, but nonetheless, it does seem like there's not much there to restrain this market. Your thoughts on just also, though it's I don't know where its connection point, but always worth noting when a Western European politician is murdered on his job. We saw over the weekend in the UK, one of the senior MPs from the Conservative Party killed. Does it tell you anything about social unrest in the country? Does it have any other ramifications, other things you're thinking about week ahead?
I don't think so. I think this particular case was somebody who was sort of some what they would call the terrorist angle, the religiously motivated, idiots who take that too far. What you had also in Norway seems to have been a person with psychological problems. So I don't think this reflects social unrest. What has taken social unrest sort of off the street so far has been these large subsidy programs everywhere to shelter people from the higher energy prices. That in itself is unsustainable. So if the winter gets harsh and if energy prices stay higher, then we have a problem. On the oil side, yeah, I agree. I mean, there is tightness now. If that's true, 300,000 barrels out because of Mars. I saw the same headline flying by. If that's true, then of course you have another impetus. Situations like that, they can peak very high, no doubt about it.
There's no doubt that the winter is still to come in terms of that potential upward motion from energy demand, a cold snap here or there, and you could certainly see a tightness. And whether OPEC reacts or not, it seems unlikely at this point. And even if they did, it's too late, perhaps.
For those playing markets, there's one country which, of course, hugely benefits from the current situation, and that's Russia. Was the best performing of all emerging markets already this year by a far cry. And you see how China and others are sort of mired in worries and in this sort of lower growth forecasts and so. But at the same time, the political situation has been such that the Russian market has been very small and actually suffered from outflows, even though it walked up all the time.
Were many of the tourists you saw in Cyprus Russian?
All of them, I think.
All of them.
It was quite amazing. It was quite amazing. Yeah, well, they explained to me they had this first wave of people coming from Lebanon years back. Then another wave, which of course was the Russians. Now they say 300,000 Russians and 850,000 Cypriots. So that's a toxic mixture. And the next one is a wave of people coming from Israel because of the high taxes there, and they have to, as countries will pay the bill. And if COVID allows more working from abroad, countries like Cyprus with low taxes and good weather will be beneficiaries.
And we can wrap it up there, and also perhaps just to note the events that happened in Beirut over the weekend, where the civil unrest seemed to ignite some conflict or old sort of partisan lines re-emerging there. There could be dominoes to fall from that. Hezbollah demonstration being attacked with a number of people killed. may trigger a reaction. We'll have to wait and see, but worth keeping an eye on, because once you get into those spaces, they tend to have sort of regional ramifications, or certainly proxy ramifications. But let's wrap it up there. The outlook for the week ahead: oil prices opening in a few hours' time with Brent at close to 85. Will that march continue? Christoph Ruhl, thank you so much as always on Sunday. Maliha Bengali, lovely to have you back, and have a great week. We'll see you every morning, 10:30 UAE time. All the best.
Thank you.